Hey, it's KP coming to you live from Corona, California. We got a lot to talk about today. Even though it's a short week, it is Thanksgiving week. Happy Thanksgiving. I know we have a lot to be thankful for, and I'm thankful for everyone that takes part in this video series, and we're gonna keep them coming. So what are we talking about this week? Really the only thing that's coming out on Wednesday is the minutes from the Federal Reserve's last Federal Open Market Committee meeting. So there could be some details in there that maybe the press hasn't seen. It might move markets, maybe not. But the Fed is one of the things we're going to talk about today. But we're going to talk about a consensus and what that means with the Fed and the Fed's rhetoric, how that actually moves markets. We're going to talk about peak inflation and all the peaks that we're searching for, peak interest rates, peak growth, peak. Then the psychology of debt and money and what it means to you. Let's get cracking on the first topic. So the Fed is all in the news. Their dual mandate: keep the economy at maximum employment and fight for price stability, which in this case means inflation. We have a ton of inflation right now. With employment really in check, that dual mandate that the Fed has had has actually allowed them to really focus on just one thing, and that's inflation. A lot of people are talking about this like the late 70s and the early 80s when there was inflation kind of at this level. During the pandemic, we had basically a government and economic shutdown, and it really disrupted our economy. It had to full stop our economy. That's different than the late 70s and early 80s inflationary environment, which was really brought on by government spending in the 60s during the Vietnam War era. During the Vietnam era, the government was spending what was called the guns and butter programs. So they were spending money, obviously, to arm our troops fighting the Vietnam War. And then, of course, back home, there were welfare and other programs to help people eat. So it was dubbed guns and butter. And that high government spending created an inflationary environment, which really didn't kick in until the late 70s and even early 80s. This time around was a very quick inflationary environment because of the pandemic and the supply chain constraint and record Fed fiscal infusion, quantitative easing, putting tons of money into the system with zero Fed funds rate. That's why the Fed is raising the federal funds rate, is to try and bring growth down a little bit, slow the economy down a little bit, and make the inflation come down so costs of goods and services are a little bit more attainable for Americans. You know, when you hear them say the Fed is printing money and the Treasury is printing money, what they're actually doing is buying more debt. So our US Treasury, when debt is created or money is printed, what's actually happening is the Federal Reserve, at the request of the Treasury Department, was buying treasuries and buying debt, issuing more debt and buying it themselves and putting it on the Federal Reserve balance sheet. So that infusion of liquidity, that buyer of last resort, the Fed, buying all of that debt, creating that debt and buying it, does more deals. It got us cheaper mortgage rates, cheaper car loans, cheaper credit cards, cheaper everything. Debt does deals. And the US Federal Reserve issued a ton of debt, and it helped reflate our economy and, quite honestly, the global economy. We are the greatest super economic power in the world, and we helped create this reflation of the global economy. Inflation is being fought, and there are voting members of the Federal Reserve, as we all know. They're starting to talk about when they're gonna lower their Fed rate hike increases. They've been doing 75 basis point increases. Now there's a big general belief in the market that at the December 14th meeting that the Federal Reserve will only raised by 50 basis points. Now the Federal Reserve, you've got all these speakers out speaking. They come out and talk after their Federal Open Market Committee meeting. They go on the shows. Are they gonna lower their Fed rate hike number? So now the rhetoric of what each of these Fed speakers are saying in the public become more important, because there is not a consensus among them. But now that we're getting towards the end of the Fed rate hike cycle, you get less and less of a consensus. So what they say matters. If people are fearful of losing a job, or they are making less money when they jump from one job to another, whatever the case may be, that consensus amongst the Fed and all that rhetoric matters now more than ever. So we're going to watch all these Fed speakers between now and the December 14th meeting, and then there's another Fed meeting February 1st Two very critical meetings, but no one has more data than the Fed. And of course, that means when they speak, they are speaking from a position of having more insight than any of us. So it matters what they say. All right, so the next topic I wanna discuss is something that the Fed is looking at with all this data, and so are we. Housing's been in a recession. People have been sitting back on the sidelines with higher interest rates and higher home prices. These data points that come out, they will peak out, right? So we're gonna talk about peaks. Peak inflation, peak home prices, peak economic growth, peak everything. What do you do when you climb to the top of a mountain? You find another mountain to climb. And that's what we do here, and that peak data is something that the Fed is looking at. What is the next challenge? If you're a homeowner or a first-time home buyer and you're thinking of buying a home or moving up in a home, one of the things that's a motivating factor is how high interest rates are. Now, again, I am not a financial advisor. I am not licensed to give you advice as it relates to your money investments. I'm just giving you informational purposes. Interest rates in the mortgage world are really predicated on mortgage-backed securities. In October, we saw rates get to their highest level that we'd seen all year. We had a time in June where rates got to their worst level, then the stock market kind of rebounded. There was some more money coming back in to stocks and bonds, including mortgage-backed securities. Then we saw a little bit more inflation come up, even as late as September. We saw inflation kind of go up a little more than expected. And interest rates, therefore, were going up. As inflation goes up, interest rates tend to go up. The bond yield on the 10-year bond, this chart that I show everybody, right around mid to late October, we see this high point on the 10-year Treasury. That's about when mortgage interest rates also hit their peak. Since then, mortgage interest rates have generally been improving, especially a really big single-day move 2 Thursdays ago when the CPI, Consumer Price Index, came out. Inflation was less than expected. So was that a sign that we've seen peak interest rates, mortgage interest rates, and peak inflation? A lot of people, institutional bond traders, seem to think so, because as you can see, the 10-year yield has been coming down ever since. So we're at a lower level. 55 basis point moves on a 10-year Treasury are really big moves, and that happened in like 6 trading days. So have we seen peak mortgage interest rates? Have we seen peak Treasury yields? We might have seen that. Now, in home prices, for example, we know that they continued to appreciate all the way through May of this year, May of 22. Since May of 22, home prices, according to Case-Shiller and home price indexes and all these different reports out there, have been coming down. Not extremely fast, but they've been coming down nevertheless. So we might have seen peak home price appreciation for the year. So if you're on the sidelines and you're thinking of buying a house, it is very important to you to make sure that you're getting a deal. Are rates coming down? Are home prices coming down? Are rates still going up while home prices are coming down? You have to think about these things. And everyone has a different timing. Maybe your lease isn't up until the spring or even the summer. You have to think about that. And it's kind of sad to think about your lease actually dictating the best time for you to buy, because obviously, think of how random that would be if when you decided to sign a rental lease is what dictates when you try and time a market. It's just how life is, but I'm just telling you right now that many people believe we've seen the peak interest rates and peak home price appreciation. That means deals are getting better, both from an interest rate perspective and a home price perspective. So we're looking at many, many peaks, and one of those peaks they're looking at is peak growth. Have we seen our economy hit peak growth, gross domestic product? If there are jobs being lost and companies aren't growing as much, this inventory, which has been building up for all these retailers, now has to get marked down on the pricing to get it moved out of the stores. And here we are in Q4, traditionally the biggest retail sales quarter of the year. If inventory and goods get marked down, then these retailers make less money and they get cleared out, then they don't order as much for future goods. And then we'll see after this Q4 rush where the demand for growth is. Maybe we've seen peak retail sales or peak economic growth. All these peaks are what everyone is looking at. So let's talk a little bit more about the psychology of money, okay? It is a very tough topic to talk about because almost half of us stress out over money. Doesn't matter if you have a little or a lot, it's just very stressful. What do you do with it? How do you invest in it? Am I making the right decisions? Buying a home is the largest purchase most people make in their life. That's a tough decision to make and can be stressful if it's your first time to do that. So the psychology of money and debt is something that's very important. So I'm just gonna speak just some things from my experience. I'm not a licensed psychologist or psychotherapist. I'm just someone that has had these conversations many times based on my brief 46 years on this planet, but I'm gonna try and talk a little bit to you about that. So let's talk about debt. People look at debt in different ways. Some people look at debt as bad. I had to pay cash. If I can't afford to pay for it in cash, then I shouldn't buy it. Now, if that's how you live, you certainly won't have any stress because you won't owe anybody anything. You'll just own everything you own and you have a good kind of conservative mindset about debt. And I am not saying there's anything wrong with that. You have to do what's best for you and your mindset. Having said that, most people cannot pay cash for a home. And cash over time, over 30 years, assuming that once you become a homeowner, that you would live at least 30 years, most people do, and have an asset that you can pay off free and clear. Shelter, the roof over our head, you need it. And most people, again, cannot pay for a home without taking on debt. So in that case, debt is good. Debt and mortgages and that mortgage instrument, that financial instrument, allows you to open a door, allows you to put a roof over your head that is over time, historically, even through the Great Recession of '08, is an appreciating asset. It is something that gives multi-generational wealth for you and your family. Now, some people will debate, how much should I put down? Again, everybody's different. Some people say, put as little down as possible so you could keep cash in your pocket. If the payment makes sense for your budget and the payment is about the same as what you're paying for rent, well then why put that money in the hands of the lender or the seller to make yourself just feel good? If your payment is about the same, then what's the problem with taking on debt? Again, everyone has a different view on this. Many people still think you need 20% down to buy a home, and that is absolutely false. The reason that 20% number is out there is because if you put 20% home on a very specific loan product, a conforming loan, then you don't need what's called private mortgage insurance. It's something that if you put less than 20% down, a third-party company, a mortgage insurance company, will help ensure the fact that that first 20% is then insured. So the lender who takes on the debt has a partner sharing the risk with them. There are FHA programs out there that only require 3.5% down. And you can get that from a gift, from an acceptable family member. So you don't even have to have your own 3.5%. If you are fortunate enough to have a family member that wants to help you get into multi-generational wealth creation, you can get that 3.5% down from a gift. If you are a veteran and you serve this country, you have the best loan out there where you have a zero money down option. You literally can have a 100% loan. And that is a privilege and honor afforded to you from the Veterans Administration because of your service. And if you live in a rural area, the USDA, the United States Department of Agriculture, offers a zero money down. If you are in a rural zip code, it's called the USDA loan, through rural housing, RH, because you're helping develop neighborhoods on the outskirts of town, which of course brings revenue and economic activity to areas that are less densely populated. So there's a lot of great products. Let's get into 7 major life events that would cause you to speak to a local originator or talk to someone about debt. Or watch my videos, if you will. That way you don't have to commit to anybody. Hey, KP's out there serving the higher purpose and helping everybody. He's helping me learn at scale. That's what we're here to do, is serve the communities. The 7 Ds, these are life events, okay? These are life events that usually are a big precursor to someone looking for a home. We put deployment first because typically deployment happens in a chronological order of life before all the rest, but also because we put our veterans first, not just here at our company at PRMG, but all throughout this industry. If you're a veteran and you're listening to this, Vetted VA, great group out there. We really encourage you to go in there and see the information about all things for veterans. Deployment, diamonds. If you get married, two people coming together to form a union and strengthening their family balance sheet are thinking of, you know what, now that we're both putting our incomes together, let's get something that's ours. Let's get a house that we own, a roof over our head that we aren't paying for the landlord's net worth. We're paying for our own wealth. What comes next typically after there is a marriage? There are children that are involved, diapers. After you are deployed, get married, have kids, you take on debt, right? You gotta get ready for college, you gotta do home improvements for your house, maybe you have a business that you wanna invest in, so you can take cash out. Now, another one, which is more common than it should be, unfortunately, is divorce. And if there is divorce, there is typically a home involved. So now the couple has to split that asset. Maybe one keeps, maybe another one's looking for another home to buy, maybe they sell the one they're in, but there's a lot that goes on when there's a divorce. It is a life event that definitely has to do with home ownership and the changing of how that happens. Our 6D is actually downsizing. So as you get elderly and you become an empty nester, you don't need this big a house. You don't want to clean it. You don't want stairs. I'm going to give you a really cool thing that I think most people don't know about. If you are age 62 or older, you can take out equity in your home in a HECM home equity conversion mortgage because you're downsizing, and you can have no principal and interest payments forever. So depending on your age and how much equity you have, there's a certain percentage which you can take out where you're literally only making a house payment of taxes and insurance. You're literally never making a principal and interest payment ever again if you are of age. As of right now, in 2022 in the fall, age 62 and up, there are products for that. And a lot of people don't know that if you sell the home you're in and you're downsizing to a smaller home, you can do a HECM purchase, a reverse mortgage purchase of your new home. Let's just say, for example, a 62-year-old, you sell your big 4 or 5 bedroom house, you have this chunk of money, you want to buy a 2-bedroom house because you're downsizing, you can put 50% down from this money on your bigger house home sale and put 50% down on the new house and never have a principal or interest payment ever for the rest of your life on a HECM purchase loan. Again, get in contact with your local originator. It's a fantastic way to cash flow yourself. And of course, the 7th and final D is death. Unfortunately, even my family, we went through it. My mother-in-law passed a year ago. My father passed about a year and a half ago. In many cases, when there is death, there's an asset to dispose of. What do you do with it? Do you give it to the living siblings? Do you sell it? Do you take equity out of it? Do you rent it out? Do you Airbnb it because it's in a cool spot? It's another life event that really has to do with mortgages and home ownership. So I hope you found the 7 Ds enlightening. I made those up. The 4 Ds have always kind of been around in our business, and I added 3 more. You heard it here first, hopefully. This is all an educational series, and I hope you get a lot out of it. We appreciate you. Please be sure to subscribe and like below for KP Talks Dollars and Cents on YouTube, and bang that like button. Of course, for those of us here on your home TV, we really appreciate you watching this show. There's some great content on here. I promise to give even more content and value add to you and your families for many weeks and generations to come. Happy Thanksgiving. Thank you.